Consumer sector is crumbling, down 1.43% this week. A critical earnings season looms. Will it spark a rebound or accelerate the decline? This is what every serious investor needs to know about consumer right now. Stay with me. Welcome back, or welcome if you are new to Financial Market Oracle. This week, we find ourselves in a market environment characterized by normal conditions, with the VIX index at 18.7, indicating a relatively stable risk landscape. Within this context, the consumer sector has been underperforming the broader S&P 500 index, with the sector ETF, XLY, down 1.43%, which is noteworthy given its significance in the overall market. The consumer sector is a critical component of the U.S. economy, accounting for a substantial portion of GDP, and its performance can have far-reaching implications. As such, it deserves our attention, particularly given the current market dynamics and the potential for shifts in consumer behavior. This sector is highly sensitive to changes in economic conditions, and its resilience or vulnerability can serve as a bellwether for the broader market. Given these factors, it is essential to examine the consumer sector closely and assess its prospects. Let us start with the technical picture and what the charts are telling us. The consumer sector, as represented by the XLY ETF, has experienced a weekly decline of 1.43%, yet remains up 7.19% on a monthly basis. The Relative Strength Index, or RSI, is currently reading 63, which implies that the sector is approaching overbought territory, thus yielding a bearish signal. This RSI reading suggests that the momentum may be due for a consolidation, or a pause in the upward trend. The trend direction is still upward, but conviction is starting to wane. Key support levels likely exist near the recent breakout zone, while resistance may be encountered at the upper end of the recent range. The current move appears to be an extended overreach, rather than a sustainable breakout, as the sector has been advancing rapidly over the past month. A specific technical setup worth watching this week is the potential for a pullback to the support zone, which could either lead to a consolidation or a reversal. The ability of the sector to hold above this support zone will be crucial in determining the next direction. Now let us look at the fundamental catalysts driving this sector. The consumer sector is poised for a pivotal week, with several key economic events on the horizon that will shed light on the health of the U.S. economy, including the GDP advance estimate for Q1 2026, PCE inflation data, and non-farm payrolls. These macro tailwinds and headwinds will undoubtedly impact the sector, which encompasses retail, autos, travel, luxury, and discretionary spending. Notable stocks such as AMZN, TSLA, MCD, and Nike will be closely watched for signs of sector strength or weakness. As we analyze the key stocks, we notice that they are signaling a mixed bag, with some companies showing resilience in the face of economic uncertainty, while others are struggling to maintain momentum. This week, we will also see several earnings reports from major consumer sector players, which will provide valuable insights into the sector's overall health. Please remember that this is educational content and not financial advice. The longer-term fundamental thesis for the consumer sector remains intact, driven by the ongoing shift to experiential spending and the growth of the middle class. With the VIX at 18.7, market conditions are relatively normal, which bodes well for the sector. Next, let us talk about the specific risks you need to manage this week. The consumer sector is facing several key risks this week, including a potential slowdown in discretionary spending, ongoing supply chain disruptions, and rising input costs. Given the current volatility environment, with the VIX at 18.7, it is essential to be mindful of position sizing to manage downside exposure. Investors should consider the potential for unexpected headwinds, such as a sudden change in consumer confidence or a surprise increase in inflation, which could impact the sector. A disciplined framework for managing risk involves setting clear stop-loss levels, maintaining a diversified portfolio, and regularly rebalancing to ensure alignment with investment objectives. This approach can help mitigate potential losses and protect investor capital. By understanding these risks and taking a proactive approach to risk management, investors can navigate the current market environment with confidence. And now for the strategic outlook. Where does consumer stand heading into next week? Our strategic positioning recommendation for the consumer sector this week is cautiously bullish, driven by improving consumer sentiment. A key theme to track is the resurgence of discretionary spending, with retail sales growth of 3.4% year over year. This is educational content and not financial advice. Please like, subscribe to Financial Market Oracle, and comment your consumer watch list below. Until next week, stay informed, stay disciplined, and stay profitable. Cheers! This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.